Welcome everyone, thanks so much for coming. Really exciting time for FinTech. The last couple of months, definitely a lot happening, and particularly this panel, because obviously the investors have a great seat at the table and have a wonderful perspective. And what's happened to David? Oh, here he is. So I'm sure this is going to be a fascinating panel. I know that there's quite a few people that are from venture firms in the audience, so that's pretty neat too. So I'm sure it's going to be a fabulous conversation. And David did ask me a few days ago to ask people to ask questions. So if you've got questions for the investors, please shoot them across. First of all, I wanted to introduce Colin McDonald, who's hosting tonight. If you want to say a few words from Shepherd Mullen.
Thank you. Welcome everyone to the offices of Shepherd Mullen. I'm a partner here in the San Francisco office. I work in the finance area. I do FinTech. We have teams that are dedicated to financial products, technology, blockchain, and the like. So if anybody has questions about our capabilities, please feel free to ask me. We've been partnering with PEMO on the Silicon Valley FinTech for a couple of years now. Three. And I guess time is flying by. And we're delighted to have our association with PEMO and all the wonderful panels she brings here. So without further ado, I will hand it over.
And just to plug for Shepherd Mullen, they're the best law firm I've ever found in Silicon Valley for the last 10 years, and we've worked with a lot of law firms. So thank you, Colleen.
Thank you.
So I'm going to pass the mic over now to Michael. Michael's from the Economist, and he's going to moderate the panel and allow the panelists to introduce themselves. Thanks, Michael.
Thank you. Well, thank you all for being here, and thank you to our panelists. As people mentioned, I'm Michael Gold. I'm with the Economist Intelligence Unit, based here in San Francisco. We're the sister organization to the Economist newspaper, and we sort of look at the longer term sort of structural trends behind a lot of the things you might read about in the magazine on a weekly basis. I will kind of be, more or less fading into the background as these, experts take us on a journey through what's hot in FinTech investments 2020 globally. But why don't we start with some self-introductions? We can start right here with Adam.
Okay, hello. My name is Adam Carson. I'm with .72 Ventures. We are investing in FinTech globally, seed through Series B generally. We're investing in sort of the two big areas of FinTech that I consider sort of the way to split the world. One is disruption of the incumbents, and then the second half is the enablement of the incumbents. And so we're sort of playing on both sides of the fence in different areas of the world, depending on what market dynamics are. Prior to .72 Ventures, I spent 8 years with JP Chase. I was leading their digital and FinTech strategy and partnerships practice. And so we were responsible for helping solve the bank's problems and help drive their roadmap from an innovation perspective and a partnership perspective by understanding what was out there from an emerging technology and a FinTech perspective. So I met with all of the different companies that were looking to sell into Chase, and now I get the opportunity to invest in a lot of them.
Hey everybody. There you go. Hey everybody, my name is Chris McCann. I'm one of the managing partners of a venture fund called Proof Capital. We're a new venture fund mostly focused on the infrastructure layers across all industries, and I specifically focus a lot of my attention on the FinTech and financial infrastructure category. Before this, I used to work at a much bigger firm called Greylock Partners, which you guys might be familiar with. I work closely with Reid Hoffman and John Lilly, two of the partners there, mostly focused on a lot of the emerging market sectors we're looking at. So yeah, thanks for having me.
Good evening, David Blumberg. And first I have to say, what a pleasure to be able to have a beer when you're having a panel. So good on you, PEMO, thank you. Much better than water. You know what fish do and that stuff. Okay. David Blumberg, founder of Blumberg Capital. We're based in San Francisco, New York, Tel Aviv, and we invest pretty much in North America and Israel, but sometimes in Europe when this fancy strikes us. We're pretty much enterprise investors, but FinTech has taken on a larger and larger portion of our portfolio just because we think there are a lot of opportunities there, as the gentleman mentioned before. We're pretty open-minded about it, but we tend to be more focused on the B2B aspects of it, the infrastructure of it, less toward the consumer, partly because regulatory, we'll get into that later. And we do early stage checks, seed and A, couple million, up to a couple million for a seed and up to 6 when we start for an A. And open-minded to entrepreneurs from anywhere in the world.
Hi everyone, my name is Michelle Killoran. I'm a principal at OMERS Ventures. So we're located in Toronto, London, and Palo Alto. We're multi-stage, multi-sector, so series A, B, and C, and certain areas of focus. So one of the ones that I spend a lot of time in is prop tech. So anything real estate related, which kind of fits under the FinTech bucket. So I've spent a lot of time looking at anything residential and also anything on the commercial side as well.
Great. So at the risk of abrogating my duties as a creative moderator, I'm going to start with a very obvious question. For all the panelists, maybe if we can just sort of go down, the list and just answer what's hot in FinTech investments 2020. What is going to be on the minds of, your firm, of the investment community overall. FinTech is obviously a very huge, category, right? So we've got, everything, prop tech, we've got cryptocurrencies, everything is in there. So maybe we can just start with that and just sort of see where it goes from there. Okay.
I think, even though FinTech has been around for a while, we're still almost at the early innings of the digital transformation of financial services. So we still see a long way for the big brick and mortar banks to transform, and at the same time, we have a lot of new up-and-coming FinTechs that are going digital and direct to consumer, and that way, direct to small business. So from my perspective, one of the most exciting things is just this layer of enablement that sits beneath both of those. In fact, there's probably a third category, which is non-financial services companies introducing financial services.
Yes.
So using their existing customer bases to either launch debit cards or lending or payments to. And so across the incumbent financial institutions, across the new direct-to-consumer, direct-to-small business FinTechs, and then this new wave of non-FinTech companies rebundling financial services, there's an entire set of companies powering all three of those different sets of customers to launch new products and to sort of innovate at that digital layer in the customer experience space. And so it could be some of the banking as a service, payments as a service, investing as a service, and those companies are selling to all three of those categories. They're selling to incumbent banks, they're selling to FinTechs, and they're selling to non-banks who want to launch financial services products. So I think in some ways, what you've been writing a lot about, the infrastructure layer, the enablement layer, it's a little bit hard to understand if you don't understand financial services because it goes into the plumbing of how these things work. But that is where we're focused a lot of our time, is looking for those types of investments. One of the companies that represents this trend in our portfolio is a company called DriveWealth. And what DriveWealth does is it essentially powers anyone to build an investing experience for their customers. It could be a direct-to-consumer, it could be sort of a self-directed offering like an E-Trade or a Robinhood. It could be a robo offering like a Wealthfront or a Betterment. It could be card-linked investing like an Acorns. But essentially with DriveWealth, all you have to do is bring the customers, bring a license, and bring some developers. And DriveWealth does all of the complexities. They're a clearing broker-dealer, so they do everything that's needed behind the scenes with a simple API platform. And that's one example of this trend. They're selling into FinTechs, they're selling into non-banks, and they are selling into banks as well.
Great, Chris.
I was going to say the blunt answer to this is after Credit Karma and Plaid and E-Trade and all the things we're seeing, I'd say FinTech as a whole category is hot. A lot of people are spending a lot more time and attention and has a lot more focus. However, I'd caveat by saying I agree with what you were saying. I think right now, if you wanted to do a pure consumer play, if you wanted to build another neobank or another consumer-focused lending application, it's going to be quite hard. The customer acquisition cost is super high on that. The competitive landscape is super high on that. So as you were mentioning, I'd almost start to look around not just the consumer apps themselves, but all of the things around that, all of the plumbing, the core banking infrastructure, the FinTech infrastructure, the regulatory and compliance, kind of everything around that, because you're going to start to see more and more normal internet companies embed FinTech features into their apps, like embedded FinTech is what I called it, but a lot of people have other kind of words for it. And then you're going to see just a lot more, like also business-focused applications as well. So we've been spending a lot of time, I'd say, on all the plumbing kind of around enabling these experiences.
So ditto, but to be a little bit more interesting, I'll give you a couple examples maybe. In the prop tech area, we've found some really interesting new financial engineering models that are able to unlock what is often an American household's largest asset, typically, which is their home. And often that home, can provide a good rate of return over many years, but in the interim, it's pretty locked up, especially if you can't get a HELOC. So we've invested in a company called Easy Knock, which you probably know, and it's remarkable and it's so exciting to help middle-class people unlock this unused asset, cash that they need from their home, and then they stay there as a renter for the first product. It's called Sell and Stay. Anyway, the idea is that they then have a double trigger. They can buy the house back at an escalating price over a few years, or they can sell the house into the market. And the alignment comes from the fact that we financially engineered it so that they have an option for up to 35% of the upside in the sale, so that if the market is down, say 10-20%, which often is in a recession, they take the first loss. So they're not going to want to sell their house unless they really need to, and then they're willing to do that. We don't try and buy cheap and chisel them down at the buying price. We sort of say, we'll buy at market, turn you from an owner to a renter, cash flow gets better, and you unlock the liquidity. So I'm just giving this as one example, but there are a lot of interesting ways that we can help the consumer and then help SMBs and help other folks by a combination of big data and AI that make the cost of underwriting or the cost of customer acquisition much reduced. Remember, why did big institutions, governments, and wealthy families benefit so much from financial institutions? Because it was so expensive to do these things. Now, with the benefit of technology, we can bring that to a much broader playing field. I call it leveling the playing field, so that everybody can get these benefits. You can have your portfolio optimized just as well as the Rockefeller family. That's great. And maybe you are the Rockefeller, I don't know. I'll pause there. It's an exciting time. I think the regulatory environment is much better now than it was a couple of years ago. So therefore, that's easier and better for entrepreneurs. I think the economy is growing, certainly in the US, very strong. We do look at things internationally, but the US is usually the first market point of entry. And then if you're also looking at the expansion of underbanked folks, that's obviously a giant market for now and future, because there's so many people who have not had traditional banking institutions, and they're getting the first leg up, and it's a wireless one, it's a mobile one, it's infinitely easier than a lot of the legacy stuff we have to deal with.
Building off of the prop tech side of it, the U.S. housing market is valued at over $30 trillion. So this asset class, access to it has been limited in the past. So if you think about accessibility, what we're really excited about is there's two sides of it. There's for the first-time home buyer, and buying a home is harder than ever right now. So getting access in these different types of products that enable you to get access is fascinating. But on the other side, a lot of these companies have a structure where they have an operating company and a property company. And this is where they're raising capital from traditional real estate investors to access the asset class from that side as well. And it's very interesting, some of these business models that we're seeing where this capital side is enabling the more traditional, say, venture side or operating company that's out there, and it's to access this asset class, which has been more difficult in the past. So anything around accessibility, we love. Also anything around increasing liquidity. So it's great to get in, but you need to be able to move around. You need to be able to get out of that asset. That's a great example of one way to do that. But looking at any ways of doing that, I think, is pretty fascinating. I think getting to a frictionless transaction for a house, which is the largest asset that you own, will change a lot of the ways that we live, mobility, anything like that. It'll be more aligned. So we're really excited about anything in that space.
Great. No, some really interesting insights there, and kind of just the sort of the very broad brushstrokes about what you guys are looking at. I kind of wanted to go back to something we were talking around the plumbing aspect of it. And Chris, you brought this up, and I think this kind of ties into something that I was interested in around, I guess, the tech side of FinTech, right? Because we were talking about artificial intelligence and machine learning, sort of optimizing a lot of these processes, right? Sort of customer acquisition and whatnot. Can you discuss some of the more sort of like nuts and bolts, the nitty gritty behind that, and then also, what exactly are the efficiencies that you're realizing that weren't there maybe like a year ago, and that maybe this year we'll see, looking crystal ball gazing, we'll see accelerate even a little bit more.
Yeah. Yeah, maybe I'll preface by saying this, like, one thing, maybe a little bit as an outsider for people looking into this space, sometimes the fintech space is really complicated because any one of these areas, like real estate, mortgages, lending, they all have this very, very, very deep infrastructure, and sometimes they intersect, sometimes they're very different. And so I will try to answer that question simply, because that could also be, I wrote a whole post on it, so it could take a long time. Maybe I'll just start with simple banking checking. With checking, I think like most people know what it is, have a checking account, and it seems very simple. However, when you actually look at the plumbing underneath it, it gets sort of complicated. For most individual banks themselves, there's usually the core banking system. So think like FIS, Pfizer, Jack Henry. A lot of people don't even know a lot of these companies. They're so sort of hidden beneath the weeds. But these are the companies that provide the core ledger, the core accounts, the checking and routing numbers, kind of all the hooks into ATM systems and all of that stuff. These are really, really massively multi-billion dollars companies with sort of huge amount of revenue attached to it. And then on top of that, when you sort of layer onto this, some of the more new things you're seeing is a lot of the fintech companies, what they're doing is they're partnering with a partner bank and using their regulatory licenses to be able to offer checking accounts inside their app without them needing to be a bank themselves. So a lot of companies are doing this through like Evolve Bank and Trust, and then there's a lot of sort of small Midwestern community banks that do this. Some of them do it via an API platform. Some of them you also need to run your own core banking infrastructure in parallel. But this is how many of the fintech applications are sort of launching and enabling their services on top of it. And it kind of goes further from there. And again, like every single subspace is very different, but that's like a very tiny brief snippet on just pure checking as an example.
And are you seeing that some of these fintechs are bringing efficiencies in their plumbing to the banks, say, that they're partnering with? And I don't know, maybe you can chime in on this, Jimmy. You were working at Chase, obviously, and obviously you must have had technology partners, right, that were kind of sitting behind a lot of some of the financial activities. Maybe you can discuss that a little bit.
Well, at the big banks, Chase, Bank of America, Wells, they actually have massive IT departments that are building a lot of this stuff, and they run it all in their own data centers. And so I think JP Morgan Chase had 50,000 people in their technology organization. So they could kind of do everything themselves. They still did use a lot of technology from different players, but contrast that to a smaller bank, a community bank, even just like a regional bank, and their IT department is managing a lot of the tech vendors that do everything for them. And these are really old technology companies. A lot of the implementations are legacy technologies. And so there's a huge opportunity for fintechs to sell into banks to sort of, let's say, just upgrade that technology. A great example is, the neobanks and the fintechs, they all came out with this really easy way to open an account online without having to go into a branch. 5 years ago, none of the big banks had digital account opening. You think it was crazy, but you pretty much had to go into a branch to open it, and certainly not mobile account opening. And now, Chase and B of A and Wells, they get the joke that it's really important to be able to allow people to open an account inside of their mobile app. So they've all done that, but it's taken millions of dollars and hundreds of IT resources to do that. So now, what is the small bank to do? The big sort of legacy infrastructure players are not moving quick enough to provide them with solutions. So, there are startups doing that. We've invested in, we just announced this week an investment in a company called Mantle that essentially does digital account opening software for smaller banks to help them compete with the large banks like Chase and also with the fintechs who have these really slick, go online, go to the web, go to the app and open an account in 2 or 3 minutes. And so there's just a lot of opportunities like that. There's a lot of little mini spaces for next-gen solutions that are digital first, don't require a banker, don't require in-person presence, and the entire sort of way that things work is changing. Everything from identity verification to the way that you open the account, to the way that you service the account, and even, the way that new products are sold. They used to be sold by a banker in a branch. How are they being sold now? Through personalization and marketing software that sits inside the application.
So when we talk about, digital first solutions, right? I mean, obviously, one aspect of that that seems to be transforming a lot of industries is AI, of course, is machine learning. Where do we see that coming into play, in most of the, to the highest extent possible in the companies that you guys are looking at, right? Is it something that big banks are trying to develop internally because they have a lot of data, or are they going with partners? How is that impacting PropTech? I want to sort of, dig into some of those aspects.
On the PropTech side, I think an interesting area where we're seeing predictive AI is around valuations and pricing. So there's a category that's improving in the liquidity space around iBuyers, for example. And what they will do is, if you're an existing homeowner, they will give you an offer like right away for the price of your home, and they'll give you a cash offer in days. And then the AI using different data sets, there's many different data sets that different companies are using to get to those values. I think that's a very interesting way on the liquidity side that we're seeing AI being used.
And I'll give a couple. One company right around the corner here called Fundbox came out of the recession of 2008-9. Interesting sidebar from that recession was that everyone said, oh, it's the big banks that are the big problems and the home mortgages are the ones that are going to suffer. But really it was small business that actually suffered, because the day sales outstanding ratio is a measure of your receivables. For a typical small business, it's 45 days. During the recession, it went to 90 days. So it was like a noose around the neck of most small business owners. They had to carry a quarter of their annual sales on their own credit back. So out of that was born, for example, this company, Fundbox, is really starting, and now headquartered and running pretty much in the US. And their world is big data. And they told me when we were investing that they couldn't have started this company like 5 years before that because the data wasn't available and the AI wasn't quite available. But we've taken out all the underwriters. So there are no people sitting with green eye shades, determining whether you get a mortgage as a small business. It's all done by machine learning, and it's very cost effective. And so we can offer better pricing, and our loss ratios have gone down dramatically. Because in FinTech, there's a dirty little secret. It's easy to lend and grow and grow and grow to satisfy your VCs. But unless you can also collect the loans, you're going to go out of business pretty fast. So you want to do things in the right ratio. So that's one. Another one, EarnUp, is an interesting example also right around here. And they start helping people automatically pay down their mortgages. You never miss it. And then why don't you have your own family office? You might not be Rockefeller, but let's have it optimized so you pay your mortgage twice a month instead of once a month. And then you shorten the term and you reduce the amount of interest you pay over time. That's something rich people have done for years. But the average person wouldn't necessarily know about that technique or be disciplined enough to do it for themselves. So these are kind of examples where AI can really come to bear and help just bring these incredible financial engineering tools to everybody.
Yeah, maybe I'll give like two other different examples. One, a company that Greylock did, I can't say the name, but one of the things that's really important for a lot of this stuff is when you start talking about AI and predictive models, it's actually having the data in the first place. And a lot of the things, again, when you look into the dirty plumbing of a lot of things in the banking space, a lot of things are on PDFs and faxes and PDFs up faxes, and it's kind of messy, and there's a lot of people that go into this.
Paper.
And so there's a lot of companies, again, it's a very simple thing, but the digitization of records and storing them in like database formats that you could actually do stuff with. Again, it's a very small, simple thing, but in the core banking space is actually hugely important and a really painful problem. The more broader answer, like I'd say out there for kind of all the entrepreneurs, I'd say one of the more difficult things about data in this space is typically banks store everything themselves. It's all on-prem, it's all in their own data center. They don't want to store anything in cloud. You were telling me some of these examples even more extreme than I thought. Whenever you want to build an AI predictive model, the thing that's the most important is data across multiple different organizations. And so if you're thinking about the space, you either have to think, how can I solve something where I can get it cross organization? Maybe it's housing data or something that's fundamentally like more public or scrapable, or how do I get companies to actually want to share this? Maybe you obfuscate it or hide it through cryptography or something, because companies aren't going to not necessarily want to share this directly. So you have to kind of find your insertion point into this.
Just two other quick examples being employed across the industry. One is in the marketing space, which is essentially a next best action or a decision engine that says what ad should you show to this customer at the same time. It's not specific to financial services, but financial services, as some of the largest advertisers, are using a lot of machine learning to essentially make that decision. Every time they have an opportunity to speak to the customer, what are they going to say based on what are their priorities, who is the customer they're talking to. So there's a bunch of machine learning and AI going into that. And then on the servicing side, we've all interacted with sort of voice assistants, and whether it's via a chatbot or a virtual assistant, there was a lot of hype around it. But if you notice, Bank of America has Erica and Capital One has Eno, and there's a few fintech startups out there that do virtual assistants. And it turns out that you can actually answer a lot of basic servicing questions with a virtual assistant and reduce, call center costs. And so that's just another example. You have to have natural language recognition. You have to have sort of mapping and ontology of what's going on. And there's a lot of sort of artificial intelligence and machine learning that goes on in that space as well.
So, when we're talking about fintech investing, obviously, we're here, we're in the Bay Area and Silicon Valley, basically, and a lot of the models for some of the young companies here is the sort of blitzscaling, right? You really want to grow super quick, establish a customer base, and then worry about profits later, right? But what you were talking about, Chris, in one of your posts is that there's the entry, so the entry barriers for a lot of these companies is so low. What are you seeing then in terms of competition around that space? Like, do you think that the companies that are really growing the quickest are sort of in the consumer space? Do you think they're more in the business, the B2B space? Where do we actually see a lot of the growth among those really small, quickly growing?
Yeah, I'd say like the more obvious one that people have seen have been the consumer ones, so the neobanks, the digital first banks, the digital first lending things. However, I guess with all the growth and all the capital frontages, what you've seen is the cost of the customer acquisition skyrocket on a lot of these things. Somebody did some analysis. I don't know if it's totally true, but even if it's directionally true, it's crazy. Like, I think the cost for a new customer for one of these neobanks was on average about $400 to $600, depending on the different channels and geographies it was targeting. I don't know if that's like exactly the number, but even if that's directionally the number, like that's very, very, very high. So again, like that's why I sort of say like, you could try to start another one of those, but it's such a competitive field versus when you look into a lot more of the B2B applications, infrastructure, even some other things that like we didn't necessarily talk about, things on the like FX side or cross-border payments or remittances. Like some of these are much more underlooked and much more higher valued areas. So again, like finance is a huge vertical with many, many, many different slices. Like pick the one that you're personally interested in and just fall in love with. Like just don't do it for the money's sake. And two, like try to pick a space that's not totally overfunded and overcrowded, because there's a lot of things you can do as well.
David, it looked like your ears perked up when you mentioned FX.
Yeah, it's okay, because e-commerce is growing a lot faster than retail, and the fastest growing part of e-commerce is the cross-border aspect, and the most profitable part is the non-settlement currency aspect of FX. So there's a lot of opportunity. There's so much friction. You mentioned the word friction. There is so much friction in the financial services area. Let me just go back to the previous statement. I think it's like one of the Blumberg Capital investment theses is about this is the era of the automation of the white-collar economy. What is more white-collar than financial services? The image we all have of somebody wearing a suit, and none of us are, but this world needs to be made more efficient. The farms and transportation were made efficient in the 19th century, but we moved from animal and human power to steam and tractors and railroads. And then the 20th century, we automated factories to make things that were craft to efficient assembly lines. The white-collar economy is so inefficient, and FinTech is numbers. this should be one of the most efficient industries in the world. And it can be done, but it needs data, which has not been available, partly because people didn't want to share, and partly because it was not feasible. Now we can share it, big data streams that we're starting to see. And then we can use these algorithms, which are incredible, which were never available because we didn't have NVIDIA, we didn't have GPUs. So we needed hardware, we needed software, we needed big data. It all is now coming together, and the consumer is ready. Blumberg Capital has been doing a series of studies with the American consumer recently, last in 2017, and then we did one in 2019, about consumer willingness to adopt FinTech and new things, and it's really moving forward. It flipped between our last two studies that now more consumers believe that financial institutions are going to keep their data safe than in the past. It was more consumers felt that they were fearful of leaving consumer information with their financial institutions. This is despite the fact that breaches are increasing. But I think what's happened is that because of FDIC and because of other insurance mechanisms, the credit card companies, people have sort of built this in. They assume that, yes, breaches are going to happen, but they're not going to actually suffer a serious loss. That's one little takeaway.
And so, for these, did you have something you wanted to add to that? Oh, okay. So for a lot of these small sort of, fintech startups, right? What do exits look like, I guess? Are they looking, how are public markets, amenable to them? Are they looking to get bought by, I don't know, a large tech company or a large bank, say, right? It seems that it's not quite so, it's definitely not the same model that you might see in a lot of other parts of the tech world, right? So maybe, I don't know if any panelists would like to address that.
Yeah, I think we've seen a raft of acquisitions just this past week, and that sort of, I think everybody has been expecting was going to come a long time. I remember being at Chase and we looked at things and we said, no way, that's too expensive. They're not making any money and they're not profitable, and we're a bank. We need to be profitable and making money. So they didn't quite get the whole grow and have a lot of users but not be making money thing. It turns out that there are some good businesses being built. I think Credit Karma is a great example of that, but that did not happen overnight. That company has been around for a long time, and it's taken a long time to grow to the size it is. Where we have made a focus on investing in companies that are really generating software as a service revenue, selling into financial services. And so there are clear exits for those. They're essentially the companies that they're going up against, the big incumbents, the Fiservs, the FISs, the Jack Henrys, the TSYS, the Black Knights, all of these big legacy technology companies buy software companies to augment, transform, and grow. And so if you are playing in more of the B2B enterprise software space as it relates to FinTech, there are obvious acquirers there. In the direct-to-consumer space, it's not clear. It's not clear if the banks are going to buy them. It's not clear that Google and Apple are going to buy them. There might be Squares and PayPals and Intuits that do make acquisitions in this space. They have more of a culture match. The one acquisition that JP Morgan Chase made when I was there was a company called WePay, which was a Silicon Valley company. And while that's been going okay, it was not it was a tough fit to put a Silicon Valley company with 250 people into a company with 250,000 people and offices around the world that liked all their data on-prem and didn't like all this next-gen software from a security perspective. So there's some cultural fits with banks eating some of these next-generation startups, but from a B2B software perspective, there's a very natural fit for and very natural acquirers for some of those businesses.
David?
Let me just go to an intermediate step. Before you buy, you try. So that was the old Cisco mantra. They would invest in a company and then they might buy it in the internet world that they turn into the Borg. It's a famous acquirer of many, many networking companies. So in FinTech, the last 2 years, we saw a dramatic change in the corporate appetite to invest in FinTech companies. One example from Canada, where OMERS reigns supreme. We have a company called Truly You, and OMERS is a friend of them. You're in Hootsuite, not Truly. Sorry, that was his name. They're both in Vancouver. Anyway, the point is that this company had us as seed investors, and then along came American Express. And what they do is KYC and AML. Okay, know your customers. It's in the compliance world, and it's global. Compliance and regulatory tech is pretty straightforward if it's domestic. When you go cross-border, it gets increasingly complex. Many different legal structures to deal with, different data sets, different languages, all that kind of thing. I mean, truly was specialized in the cross-border hard part. And so this last round was led by Goldman Sachs and Intel and Santander all came in joining Amex. And I'll give it as an example, but it's like, wow, what an incredible group you have there of corporate investors joining the little VCs. So we're starting to see that over and over, and I think it's a recognition that when you're at Chase, I'll give an example from Chase, and then one from Amex, the CIO of Chase told me, probably about 5-6 years ago, that their biggest expense, biggest operating expense was regulatory and compliance. And it was putting them in the position of Gulliver, like, tied down by the Lilliputians. They couldn't move. And for another example, Amex, I came to speak to some of our CEOs. He told me that for them to do a new initiative, $5 million of legal had to go in before they could sort of move on any new serious initiative. So these big guys, they have 50,000 programmers. Bank of America, I think, has 100,000 programmers. But they're just stuck. It's sad because they are great institutions, but they're partly stuck by technology legacy and partly by the incredible regulatory burden that our government has put on them, I think. Maybe well-intentioned, but almost always misfiring and causing just more cost to the consumers than the benefits. Anyway, it's getting better because the startups, it's not a we destroy Chase world anymore. It's we're going to cooperate. There'll be some competition, there'll be some disruption, but mostly there's going to be cooperation, in my view.
Yeah, and then kind of on the other side of it, we have the role of big tech, right? And Facebook obviously made news last year, for trying to launch its own cryptocurrency, which who knows whether that will see the light of day. In fact, the Economist cover story this week is on, the amazing bull run of these, basically these 5 essential companies that have essentially come to dominate the American economy, except more or less in finance, right? So do we see this changing at all? Is Libra the beginning of something, or is it just, a sort of a stumble toward a finish line that doesn't really exist? What are your guys' views?
Yeah, I guess my thought on that is a little bit less on just the pure big tech company side, and maybe back to the one of the themes that we talked about earlier of this whole concept, at least I was calling in other people, called embedded FinTech, is you're seeing more and more of these tech companies actually want to own the financial sort of premise of the customer life cycle. They don't necessarily want to be the bank themselves, but they want to offer all the banking features. So think if I'm Uber, I want my Uber drivers to be able to have an account in the Uber app, earn their earnings in the Uber app, be able to issue a card from the Uber app, be able to spend it, be able to leave their money there, be able to, maybe even savings accounts or money market accounts, or maybe even brokerage accounts. Wouldn't it be great if sort of the whole value chain was internal to my app? The implications of that are really interesting because if you take that to its logical conclusion, companies, the financial services of a company might actually be a better monetization channel rather than advertising itself, or maybe even more than subscription services, maybe. So what you're seeing is kind of the very, very, very tip of the iceberg of these tech companies starting to play with financial features, which I think this is a longer term trend we're going to see a lot more of.
And go ahead.
It's a bad analogy, but FinTech is to enterprise software as alcohol is to the food and beverage category. It's the highest margin general area. There are a few exceptions to that, but it's a meaty area. A lot of it driven by inefficiency and many, many players taking a cut along the way. So the promise of the efficiency that AI, big data, and new tech platforms bring is streamlining it. Some people will get cut out, some middlemen will go away, but the consumer will benefit, the small business will benefit, society will benefit, because again, if you have frictionless capital, it really can help grow things. Think in your life, if things didn't cost as much to borrow, or they were more liquid and they were less inflexible in your assets and so on and so forth. You could move things around, readjust your portfolio balance because you had a new kid or because you need to expand your business, whatever it is. That's a good thing. So the world is getting better. And the world is also, there's another interesting point that's not well appreciated. The world is getting richer very fast. From 0 Jesus, carpenter, average income $600 a year in inflation-adjusted numbers, till 1800. The world grew at 0.1% GDP per capita for 1,800 years. 1800, the bond market started, the capital market started. We started moving capital to higher, better uses and getting return on it. And the growth rate magically went up to 1.25% per year, despite increased population. And from 1975 onward, it's been growing at 3% plus per year. The world is getting richer really fast. Poverty has dropped 94% in last, I think, 40, 50 years, or 200, maybe 200 years. But it's incredible. So all these people need bank accounts. People didn't have 80% of people didn't have bank accounts 2 decades ago. Today, many, many more do, and ultimately we'll get to the place, hopefully, where everybody does. Okay, stop.
Yeah, and I wanted to actually come back to you on one point, because the one thing that I think when we're looking at the relationship with big tech and finance, or even small tech and finance, is regulation, right? And you having worked at Chase, must have entered your day-to-day lexicon in various different ways. So what do you think are the main factors that I guess tech, both big and small, will need to think about as, say, what Chris was saying, they're sort of adding these sort of financial accoutrements, right, to what they're doing.
Well, it's been talked about that it's the sort of regulations that slows the big financial institutions down, and I think that that's one of the big reasons why we haven't seen the big tech companies jump headfirst in financial services, is because their advantage in this world seems to be able to move fast and fail, and you don't necessarily want your bank or financial institution to be moving fast and failing, or, oh, sorry, that product didn't work, we'll try again later. Like, you don't see banks doing that very often, and I think that that's one of the reasons that has kept the big tech companies out there. That being said, if you boil down financial services to its core layers, it's at this point, it's money is data associated with an identity, and that's payments, and that's why we've seen the big tech companies go into payments, is because with mobile phones, they own the identity to some extent, and they know how to deal with data, right? And they're also global, right? So they can introduce this stuff. So, even talking about machine learning, Amazon does quite a bit of lending to small businesses behind the scenes. Apple and Google with their mobile devices are doing a lot of payments, and Facebook is saying, hey, we have a big play in identity here too. Can we take a small piece of this global payments volume? A small piece of this global payments volume creates really big market caps like Visa and MasterCard. And so that's not, that is very attractive to the big tech giants, but I think we've seen them stay away from core banking simply because of the risk associated with slowing down and the oversight and the burden that comes with being a bank. And so unclear if they're going to ever do that.
All right, you've got about 2 minutes before we're going to Q&A, but go ahead.
Two very quick points on the changing terms of trade, big tech specifically. I'll start with that one. Goldman Sachs and Apple, I believe, recently launched a new credit card, right? Now, the terms of trade are very interesting. Traditionally, the bank would get the big money part of it, and the marketing arm would get the change. Apple got the big money, and Goldman Sachs got the change. So that's an interesting transition. Then also in the investment side, let's go way in the future. Blockchain, well, it's kind of coming here now faster than we thought, partly because I'll give you the, I think it's 2016, 17, the prior year, well, maybe it was 15, none of the top blockchain-related deals had corporate investors. But the next year, all of the top 10 blockchain deals had corporate investors. So we're starting to see people move with their feet. And they're starting first by maybe investing, and then partnering, but then there will be acquisitions. And of course, some of the independent startups will go out and become giant companies of the future. But there's increasingly understanding that this is going to happen. It's just a matter of when.
Great. All right. Well, let's move to Q&A. We've got about 15 minutes. I'm sure there's some burning questions in the audience. Do we have any mics that are going to go around? Or all right. Go ahead.
Thank you so much. My name is Gabriela. I had a question with respect to the point on KYC and AML. It's definitely one of those areas with huge friction, not only at the consumer level, but even at the investment firms level, going cross-border, it becomes a pain. So as you think there's more innovation coming in, and then
what?
more innovation coming into the space. The question that I had is, banks actually take a different perspective on regulation. So some of them say, I'm just gonna comply with it day one, and like they creep in advance. Other ones say, you know what, I'm gonna be in the second tier. Other ones say, I'm gonna be in the third tier. So there's the question of complexity in the regulation, which is changing, right? It's a policy matter. And then second, the level of adoption of the bank depends on the bank, right? So obviously within certain parameters provided by law. How do you think FinTech can play in that space when there's really too much uncertainty in terms of what's gonna happen and the speed at which certain banks will adopt it in different regulations? Example, in different locations, example, Europe and FATCA. So just curious what your thoughts on that was.
I guess a few thoughts on that. One, again, it very much depends on what category you're looking in and then what jurisdiction you're looking at. If it's all intra-US versus if it's completely 100% cross-border, very, very, very different set of circumstances. I guess maybe focusing more on sort of just pure digital bank side US. Most of them, again, are borrowing the charters of an underlying bank, and they need to follow whatever compliance and regulatory process that bank follows itself. And then the interesting thing when you look at more of the sort of KYC, AML, and then even more of the reporting sides, like some of the SAR reports and CTR reports and all that, for all these FinTech companies, it's not a nice to have. It is literally they need to do it, or else like they are literally violating laws. So I actually think, like at least personally, this portion of it, especially on an infrastructure side, is going to become much, much more important. Because if this trend happens of all these companies embedding FinTech services into their applications, they're going to have to do all this. Like they can't sort of skip around this. And again, I think the more cross-border you get, the more complicated this gets.
And I'll just give the example from Chile. They set up in Canada, they were Canadian entrepreneurs, but they specifically set up in Canada because it was after the Snowden affair. And a lot of people were concerned about databases and traffic passing through the US, so they were there. Now, Canada had another benefit, and that was that the Canadian rules are extremely strict on privacy issues. So they took what I call a hub and spokes model. They have no data that they keep themselves. They were a Q&A session for KYC. If you want to apply to my bank, you'll fill in your data online, and then my TrueLead application is verifying from the various databases we partner with, does she live at that address? Is that her right social security number? So we don't keep any of the data. We're not a site for hacking because we don't have anything to steal, but we're verifying by setting up this yes/no ranking and profile of you, and that also complies now with all the European GDPR. So we kind of built the architecture the right way. I think if you've done it that way, that's great. But the world of the future is fragmented, it's complicated, different regulations, as you said, so you have to build for this kind of light, agile future, and it's not easy, especially for legacy folks. Advantage for young fintechs.
I had a question. So geographically, where do you think the top fintech startups are going to be coming from?
That was actually one of my questions I wasn't able to get to, so thank you.
So we're investing globally around the world. We have a concentration here in the United States. Over the past 3 years, we've made a lot of investments in Latin America. So we see down there, and I think that there's been just a lot of activity in Mexico, Brazil, Argentina, Colombia. So a lot of investments in Latin America right now. And as we look to the next 3 years, I think there's going to be a pickup in Asia Pacific. Sort of Southeast Asia, and then also we're keeping an eye out on Africa. So this is truly global. In some ways, Europe was a little bit ahead of the United States with regard to some of this disruption in the neobank trends. That's just a hard market to operate in. Every single country has its own sort of banking ecosystem and different customer preferences. But yeah, Latin America, Asia Pacific, and then sort of on the bleeding edge, I think, would be Africa.
I didn't hear you mention US. Are you low?
No, that's our
here?
largest concentration.
Oh,
is
sorry,
in the
I
United
missed
States.
that. Okay.
One quick comment to add to that. We're primarily focused on the US, but when you start to look at places in Asia, the payments and banking infrastructure is totally different there. One just like quick example, so people, particularly in like China, mainland China, people are just much more comfortable with keeping their assets or their money in a digital wallet with a digital balance. I was with my wife and kids in Xi'an, like out in the middle of kind of nowhere, and my son was crying for this ice cream. And there was this vendor, it was in the middle of nowhere. I couldn't speak Chinese, she couldn't speak English. And I was just trying to buy my son the ice cream. I was like, please take the RMB, he's crying, he wants the ice cream. And she's like, no, WeChat Pay. I was like, I'll pay you more, like literally, I just want the ice cream. She's like, no, WeChat Pay. I'm like, okay, fine, I had to do it all. It's interesting that is the first order preference. And again, it's a very simple thing, but everything sort of stems downward from there, where if you have everybody holding digital balances, payments, FX, lending, like all the mini program stuff, it starts to have just like a very different trajectory of where it goes from. So I think it's a super interesting ecosystem to watch and pay attention to.
So one sort of follow-up point is, do we think that maybe in like developed economies, like Europe, America and whatnot, it's kind of more the, I guess, higher order sophisticated financial services and investing, as well as maybe B2B, and then I guess in more developing markets it's kind of more like leapfrogging to basic payments, connecting the unbanked? Do we think that that's kind of a valid way to look at it?
Fair division, rough justice for the question.
Right.
But opportunities all over the place. Lots right here and lots further afield.
All right, yeah.
So Andreessen Horowitz and partners within their firm and other VCs are saying that fintechs have a stronger chance of success at becoming full stack, including services along with technologies to increase margin, increase their protective moat. Curious what the panel, do you align to that thinking, and what's your thoughts in that general space?
Maybe I'll start with a little bit that I've seen some other areas where you're a pioneer. And I'm not sure in fintech it always applies, but I'll give you an example. Double Verify in the ad tech space. They were a pioneer. Nobody had done anything. There wasn't much regulation. This is for protecting against ad fraud and make sure the advertiser gets what they pay for, that your advertising geographic target is actually adhered to, and there's no negative adjacency. Anyway, the point is that the industry started to do self-regulation, and that's lighter than the government regulation. But what happened is that because of this regulation, they started building to it. They were on the committee, okay, and the other players in that field were on the committee. You start to see what is needed by the industry. You start building, and then you're building your own moat around yourself, because the other folks that come in as startups, after you've been in there for a few years, have a much higher order of stress to try and achieve that multiple requirements that they have to jump through to meet the regulatory requirements, either self-regulation or government regulation. So fintech is notorious for heavy regulation. Again, it's gotten lighter this year's rather than prior, but in the US anyway. But I think that the complexity for international is always overwhelming. If you're talking about full stack, if you're taking international, then the complexity of and the difficulty of building regulatory moat is really hard. Domestically, it's easier. Internationally, it becomes really tough. Maybe you have something smarter to say.
Maybe just a short general comment to that is fintech is the agglomeration of fin and tech. And I'd maybe even add a couple more onto that, where it's not just a technical stack, it's actually the regulatory stack, and probably even more important, the compliance stack, the fraud stack. Like there's a whole bunch of these different things. And again, like one geography versus multiple geographies gets even more complicated. So it's not impossible, it's a much more gargantuan task than just building a pure technical stack.
Michelle, I'm just curious, in prop tech, do you see this sort of full stackization at all, or it seems like it's much more in terms of specific entry points, right?
One trend we see like in prop tech as we're looking at this space is kind of there's a lot of tech enablement. So instead of building a software that you're selling, maybe you're going to create a tech-enabled brokerage or a tech-enabled property management where you're doing everything and you're using technology to optimize it. So I think that's what we're seeing is kind of a variation of what type of technology is being used. Are you creating software that you're selling, or are you kind of creating the future brokerage or something like that? So that's kind of how we spend our time trying to figure it out. I think from a regulatory perspective, it's all about geography expansion. Like even going to different states takes a lot of regulatory work, but you want to make sure that there's the scalability. And then even if you're going across the different countries, depending on what you're doing to the real estate transaction, that can be really hard. But I think the tech-enabled side, we've been spending a lot of time there, which is fascinating.
We'll go to the back over there, yeah.
Hi. I'm a startup founder in the mortgage space, and this question is for anyone who has a passion or interest in residential mortgage. Consumer mortgage is like the largest and purest consumer commodity with 8 million transactions a year. And smart people that know it's a commodity, they try to get to the bottom of the market, but there's no resources to help them get there. So where I see an opportunity is to create a platform like a reverse auction to pretty much drive the price down. To David's point, it's just numbers. To Michelle's point, it's a lot of friction in acquiring a property, and a big part of that is picking a mortgage and working with the loan officer. Sometimes it's multiple lenders. So my question is, has anyone seen anyone try to actually do this? And not like a lending tree thing where you open the gates to salespeople and you get 10 calls immediately. Like something more formalized to actually help the consumer execute fast, easy, at the lowest price.
Yes, but no. Yes, but not in your area. Well, we've seen it, and we invested in a company called Lendio, and there are a couple of competitors. It's a marketplace for small business loans. And small business loans are even more complex than mortgage loans, because you might need leasing equipment, you might need a line of credit, you might need a mortgage for a building, you might need factoring. There's all kinds of choices that you want. And when we saw the Lendio guys come in and talk to us, we said, we've been waiting for you. We knew that all these specialty type lenders that we were financing for SMBs, we'd have to have some kind of a marketplace. So it makes a lot of sense. Your idea is a good one. I don't know the issues of state regulations, which might make it more complex, which don't generally affect small business lending, but go for it. It sounds like an interesting area. We'd love to hear about it.
Yeah, we'd love to hear more.
Cool. Some deals happening here. Questions? Yeah, go ahead.
Go.
Yeah.
For fintech companies that involve access to money for underwriting or lending or capital markets, I've noticed that a lot of small seed stage startups, find some source of money, some rich person, some backer, but always end up going up market because, when you need billions of dollars for $1 billion company, that is concentrated in big private equity or, public markets. Is that subject to change, or will the money that drives and fuels the fin part always be in these big institutions?
I'll answer last, but I will answer.
Just in terms of if you're looking to get money to lend, like there's really only two ways to do it. You can either go to the big banks who are helping to essentially fund your balance sheet, or you can raise money from venture capitalists and try and lend that to get the flywheel started. But ultimately at scale, you're gonna need access to significant amount of capital, and don't see any other place than that's coming from the big sort of Wall Street banks that are putting money in, or there was a little run at it from sort of a equity crowdfunding perspective, or from a crowdfunding perspective, right? But that didn't prove to work from a retail perspective. It's just a small portion of those big lending marketplaces now, where the majority of capital is coming from one or two big sources, or sort of a consortium of Wall Street.
Vision fund.
I'll tell you a quick answer to my friend Gil. He's very smart. It's a really good question, and you can tell I'm kind of an optimist about the future, and I think it's going to be a more democratic, small d, kind of future where we're getting more spread of opportunity. A couple of things why. The big data and the AI and the new hardware platforms make it cheaper for everybody to get involved. The deregulatory environment for right now makes it easier for entrepreneurs to get started without burden. But here's the amazing thing. The cheapest way of financing is the securitization market. The bond market is really where it's at. And it's much cheaper than bank lending. And so what we're finding gloriously to the benefit of our startup portfolio is that as they start to grow up and they have these cohorts that start to recur and they show good payback ratios, et cetera, they're starting to become attractive to large buyers. And I'll just tell you some names. PIMCO came in and bought all of the debt book of one of our portfolio companies. Blackstone came in and bought all the debt book of another one. And that's just, in financial institutions. But The next step lower, which will drop the cost of borrowing even lower, is the securitization. And so for Easy Knock, we think Blue will be able ultimately for this sell and stay product to offer below market rents to people because we have such cheap financing that we can offer people. And wouldn't in the Bay Area that'd be a marvelous thing to be able to offer. So it's a bright future.
All right. Oh,
I
last
think
comment.
just talking to companies, because we're multi-stage, we talk to Series A, B, and C. That's ideal, like getting to that stage, but I think it's definitely an evolution. Like where you start, like your capital source at the beginning of when you build the company, that it might not be low cost yet, and you're getting to lower costs of capital, and then ideally you get something that fits your model. But I think when we talk to companies, it's just interesting to understand them, like watch them go through that evolution, I think, and depending on where you're at, I think it's important.
All right, well, thank you all so much. I think that's all the time we have. If there's any other questions, I'm sure you can talk to the panelists one-on-one out here in our little reception afterward. But thank you all. I guess we'll hand it back to Pimo now.
Thanks everyone for coming, and how about a great round of applause.